us on the show right now, Mihir Vora. Mihir, hi, morning. How is it that you're assessing the market mood? Not just that you've got the big election verdict, which is now just a week away, but you've also got newer things like this entire tariff spat between US and China. It still doesn't seem like it's a done deal yet, or we've had a closure on this one, because again, overnight Trump says that, there is perhaps some hope of a truce actually coming in by. Do you think this is going to continue to weigh heavy on the market, all this uncertainty? What's it leading up to?
Hi, good morning. Yes, these are quite open-ended issues because, like Brexit, the trade talks, etc., these don't seem to have a finite timeline, and these kind of come up when things are hotting up. So you see this huge bout of volatility. Same for Brexit, and then people and the markets forget about it for some time. We think things are back to normal. So I think this volatility associated with these global events will continue. And of course, as you mentioned, we got a big one coming in next week, which is the results elections. So I think we should be ready for some more volatility in the next few weeks.
Sure. Mihir, if you're underweight on asset allocation currently, would that change post-elections given the global scenario, or would you still be tentative?
So we're keeping some cash on the sidelines, and when there is this extreme volatile phase, you do see individual stocks really getting beaten down beyond fair values. So we're keeping some ammunition dry for it. So at this point in time, since we are getting mixed signals from the economy, and this uncertainty continues on the political as well as the global front, we may go in more for a stock-specific approach, look to see where there are instances of stocks or segments of the market getting unreasonably beaten down, and pick those stocks. We're not taking a big broad call either on the market or on the macro front.
Mihir, hi there, good morning. Among sectors that you're bullish on, you continue to have a fairly positive stance when it comes to the oil and gas space. What is making you so bullish on this sector, and what is the particular theme that you like?
So in general, we do believe that valuations have been beaten down, especially over the last 6 months in the OMC space, because there are concerns that the OMC, especially the marketing margins, may not sustain in the face of high oil prices. So while it's difficult to take a call on oil prices, we do believe that in the long term, oil marketing companies will continue to make decent margins, and given the way the valuations have been beaten down, probably there is limited downside left. So that's on this segment. On the other couple of big companies in the refining and petchem space, not only structurally, we do believe that there are companies which have executed growth plans, and those plans have come on stream. But in some of the companies, there are also optionalities in terms of some of the parts of businesses which are new in nature, but probably can get value unlocked at some point in time.
Okay. How much of a risk do you feel is a lack of a majority post-elections, Mihir? Given the cautiousness in the market right now, the current mood, what are you pricing in?
As of now, the market is not positioned for a unstable coalition. That's our view. So either ways, if there's a stable government, then I think the markets will then focus on fundamentals and the recovery from the current down cycle that we are seeing. But if there's an unstable coalition, we might see a further round of uncertainty and volatility in the market. There still might be some downside left.
Okay, so we were discussing this earlier as well in terms of certain pockets that would be perhaps the most sensitive to those election results. What are you also watching out for? Would it be financials, consumption? Where are you focusing?
So as of now, it looks like the retail-oriented banks probably have the most visibility, along with some improvement in a couple of the large corporate banks where we have seen probably the bottoming out of the NPA cycle. So in general, private sector corporate banks, both on the retail and corporate side, seem to be a spot to watch for. Broadly speaking, the trend of them taking away market share from the PSU segment, and now even the NBFC segment will continue. So that's one segment that can give us visibility for the next few years. Discretionary, consumer discretionary as well as FMCG, while we are seeing slowdown currently, these are not segments which can stay down for too long. So at the right valuations, these are segments that we would be looking to buy into. And even metals have gotten beaten out quite a lot. Of course, that depends on the China story and how the trade talks go. But those are also some pockets of value that we are looking at, apart from the energy space that we already talked about. So I think in general, stock-specific opportunities are emerging because of the beating down that some of the stocks have gotten across segments. So we'll probably adopt a more stock-specific approach now.
The outlook when it comes to the currency, because reports seem to suggest that what with the trade tensions with the US and China, that we can see the yuan come under pressure, and that too will have a cascading effect on our currency, which sort of mirrors the yuan to a great extent. Are we bracing ourselves for yet again those October lows of 74 to the US dollar?
So at 68, we thought that the currency has topped out. So I don't think there's a case for the currency to appreciate beyond 68 at this point in time. But whether it goes to 73, 74 will really be a function of the trade talks and the global risk on risk of trade that can happen related to this. So it's a difficult one to call. But as they are from these levels of 69.70, we think that there is a normal 3 to 5% depreciation that will happen over the next year. Of course, barring unforeseen events like the trade talks, etc., that we are talking about.
What about the overall valuation setup? Do you think that currently we're looking at fairly expensive valuations, and when would you seek some sort of comfort on that front?
So aggregate valuations do look a bit on the expensive side, but then we need to break it down into stock-specific, valuations. For that, I think in the last month and a half of volatility, there is some value emerging even within the Nifty 50 stocks, and that's what we should be focusing on. In the mid-cap and small-cap space, of course, the valuation correction has been much sharper. I remember last year the Nifty mid-cap index was trading almost at a 30% premium to the Nifty large cap index. Now that the premium has almost vanished, probably maybe even at a bit of a discount. So I think there's a lot more value that has emerged in the mid and small cap space, and if things stabilize, probably we'll find more value in that segment.
Great to have you on the show. Thanks so much for taking the time.